Welcome and good morning. You're watching Power Lunch East Africa. I'm your host, Ridhima Shukla, and we're coming to you live from Kigali, Rwanda. It is the 22nd of February, 2024, and as we speak, the governor of the National Bank of Rwanda is announcing decisions taken by the MPC Monetary Policy Committee yesterday. Our senior correspondent, Abby Agina, is currently on the location to bring us a live feed of the governor's speech for you to tune in. Other key speakers include Deputy Governor M. Soraya and Chief Economist of the BNR, Thierry Kalisa. We're also joined by a senior analyst from BK Capital who will help us unpack the new monetary policy stance later in the show. But first, let's catch what the governor has to say.
So the global economy continues to be really fragmented. Trade has been affected for the last 4 years, let me say, from COVID time. Then we had the Ukraine war. Then today we are having the Middle East crisis. All these have been affecting the global economy. Then on top of that, we have issues with the climate change that affected mainly our parts of the world. So that is the kind of environment that the global economy has been operating in for more than almost 4 years now. And with that, we see the performance of the economy, where it had picked up 2021, 2022, it moderated in 2023. Expected performance of the global economy 2023 is 3.1%, and expected to maintain that in 2024. So these are numbers we are getting from the World Economic Outlook published by the IMF, and these are latest numbers for January. So we expect to see global economy remaining almost constant for 3 years. This last year 3.1, this year 3.1, and next year slightly increased to 3.2. And this sort of slow performance is mainly linked to the disruption we still have across the world because of the wars. Also the tight monetary condition that we are experiencing linked to the tightening of central bank rates since 2022. That, of course, continues to slow down the global economic performance. And for the Sub-Saharan Africa, we expect to see still there was reduced performance for this year, last year, 2023, to 3.3%. Expected to slightly increase this year to 3.8%, and next year to 4.1%. So more or less the same conditions driving the economic performance of Sub-Saharan Africa is linked to the global economic conditions. The other point we track is the prices across the world, because that really directly affects our mandate as a monetary authority. For the global commodity prices, we saw this reducing for last year, almost throughout last year. Slight increase in third quarter of last year when you look at the global energy index. But overall, when I look at the overall reduction in the energy index, I think, let's see if I have the table here. Yes, the energy index overall for last year, 2023, is reducing by 30 by 30%. So that's you see that in our numbers, in our inflation numbers. Same with the non-energy index. So we see all commodity prices really reducing throughout the year last year, though there was slight increase in third quarter, but overall there was general reduction in the commodity prices, and this is expected to continue this year. As you see, for global energy index, expected to reduce by 4.5%, and the non-energy index reduce by 3.1%. And this has an overall impact on the global inflation. Next slide, please. So the global inflation is reducing to 5.8% this year, from 6.8% in 2023, and we had 8.7%, if you remember, in 2022. So it has been going down, and it's expected to continue this downward trend even past beyond this year. Sub-Saharan Africa registering the same downward trend, though slightly still higher than the global average, so reducing from 15.8% last year, 2023, to 13.1% this year. So that is the summary of the global economic performance that really are linked or impact on what we see on the domestic front. So looking at the domestic economy, the real economic performance remains strong. As you saw in the numbers published by the Institute of Statistics, the first 3 quarters of last year, we registered stronger growth than was projected. Overall average of 7.6% for the first 3 quarters. And when we look at the composite index of economic activities, these are frequent economic numbers we track here at the central bank. We see the fourth quarter remaining strong as well. So the composite index of economic activities increased by 7.2% in the fourth quarter. And as you see that graph, normally our composite index of economic activities is always in the same direction as the overall real GDP performance at the end of the day. And so with this, we expect to see 2023 performance higher than the 6.2% that was originally projected, based on the numbers we already have for first 3 quarters, but also the composite index of economic activities we saw in the fourth quarter of last year. Looking at the external sector, continues to be a bit weak, with the exports growing overall for 2023 by just 1.7%, and bigger increase imports by 6.8%. And when you look at the fourth quarter that maybe this monetary policy committee focused on, there was a bigger reduction in merchandise exports by 8.7%. Similar reduction in imports, but much smaller than what we experienced in exports. And this was mainly caused by reduced commodity prices of our primary exports, mainly minerals and agricultural products, but also impacted on the volumes of our coffee and tea exports, were impacted by the unfavorable weather conditions we had over the last 2 years. So all that together affected our export performance last year. And because of this low performance of our exports, we saw the trade deficit widening by 10%. So that's really a summary of the external sector, but we see good performance in service exports, that's tourism receipts, good exports good performance in remittances, so that helped to cover the gap we see here. But also because of this and because of the tightening US dollar, because of the tight monetary condition they have back home, that has had an impact on the depreciation of our currency. As you saw again in our reports, last year we had maybe the highest depreciation we've had for quite some time now, at 18.05% last year. Coming on interest developments, which is our main focus as a monetary authority when we take policy decisions, here we expect to impact the interest rates. When you look at the short-term market rates, the interbank rate increased from 6.8% in Q4 of 2022 to 8.25% fourth quarter of last year. This was in line with the increased monetary policy stance that we kept on increasing over the last 2 years. Though the lending rate remains really, in fact, slightly reducing from 6.5 to 15.78, this was mainly driven by the mixture of the loans that were given last year. We see short-term big loans dominating the lending of last year, and normally these are able to attract low interest rates. So that's the main driver of the reduction we see in the lending interest rates. Otherwise, the short-term money market rates, the T-bill rates, the government bond rates, the deposit rates, all these increase in line with the monetary policy direction we are giving throughout the last 2 years. And when we look at inflation developments, now coming to our own inflation, as I said, we can link this to what we saw on the global side. So we saw, as we had projected and as we had communicated to you throughout last year, we expected inflation to continue reducing and be within single digits by the end of the year. So as you see, the fourth quarter we registered 8.9% inflation. In fact, for December, as you see on the slides, on the next slide, for December and January, inflation has gone back into our band. So this can be linked to three main factors. So one was of course, the decision taken by the central bank as we continued tightening our monetary policy. We wanted to impact on this inflation. But the government also took different decisions. One is on the subsidies on public transport, subsidy on fuel, subsidy on fertilizers, and removed taxes on some of the foodstuff last year, plus a lot of efforts in mobilizing farmers for season A last year. All these have had a positive impact on the reduction of prices. Also, the reduced global commodity prices that we've already shown in the first slides had impact on our core inflation, with a lot of imported food and other commodities reducing. Plus also, as you see, the energy inflation, it has really remained below 5% for more than 6 months now. And this could be linked to the reduced oil prices globally, but also good conditions last year for the solid fuels within the country itself. So as I was saying, this is the graph that shows inflation developments peaking at 21.7 in November 2022 and continued going down to 5% last month. So this, again, as I said, it was in our projections and as we had communicated before. So you see a lot of commodities, especially agricultural commodities, fresh food commodities have really gone down. These are numbers we are showing. The 5% is inflation, reduced inflation, but for most of the agricultural commodities, we've seen reduced prices. That is negative inflation in most of the commodities. And with this, we expect overall inflation this year to remain within our band, and in fact, averaging around 5% for this year, 2024. However, despite these projections of low inflation, let me say, within our band, there are some associated risks of the geopolitical tensions we continue to see in the Middle East. War in Ukraine is not yet over, and so other challenges related to weather conditions. Today, we are doing well with agriculture, and we expect season B to be good as well. So the numbers we show there, 5% projection, we expect normal agricultural performance throughout the year. So it's only these two risks that are mainly could affect these projections we are giving here. And because of all this information, we decided to maintain the central bank rate at 7.5%. And we expect, if the projections we have as indicated of 5% throughout the year, we might start reducing the policy rate in the next MPC rounds, depending on how these economic variables behave going forward. So far what we project is positive, and if it continues like this, then we might start reducing the policy rate. But for now, to stabilize the prices, to be sure that we're on the right track, the Monetary Policy Committee decided to maintain the policy rate at 7.5%. So that's a summary of the outcome of the Monetary Policy Committee deliberations and decisions. On the Financial Stability Committee, we continue to see strong performance of our financial sector in general, overall across all the subsectors of the financial sector, be it banking, microfinance, insurance, pension, payment system. They all remain strong, as we see in the numbers in the different slides. But here is a combined picture of the overall financial sector, showing assets growing by 20%, mainly linked to the good economic condition that we saw, good performance of the economy in general. But we also saw increases in deposits and efficiency in the performance of the financial institutions in general. As you see on the other side, so this performance also indicates how the financial sector continues to contribute to overall economic performance and resilience. With the back to the other side, please. Yeah. So, as you can see, the financial sector assets have increased as a percentage of GDP, have increased to 66.7% from 64.9% last year. So this is a good development that shows more deepening of the financial sector and better impact or contribution of the financial sector to the overall performance of the economy. Here we focus on the banking sector, showing the increased lending to the private sector, with the outstanding loans increasing by 19.2%, and new authorized loans increasing by 38.7%. This shows more appetite by the banks to lend, but also more demand of loans from the private sector, from the economic actors in general. And it's also linked to reduced credit risk, as you see in the numbers in the next slides. So they are better quality of the loans that banks are giving, and as they improve their underwriting practices, they are able to give more loans. And so this is positive to the overall economic performance, but also the performance of the banking industry in particular. This slide shows the prudential numbers that we track, which shows the stability of the banking industry. So the capital remains strong. So this is a measure of how the banks are positioned to deal with any adverse shocks that might affect their performance. And as you can see, it remains really strong above. Normally, we don't expect any, what we call the capital adequacy ratio, which is a measure of how strong the capital of any given institution is. And at 23.2%, we're above the 15% minimum required. As I said, the quality of the loans have really improved and remains below the 5% benchmark that we've given ourselves. And so this shows good performance of good quality and efficiency of the banks in approving and administering their loans. The liquidity ratios that we show there is also remain strong, and then the profitability continues to improve and remain strong. And again, as I always say, the most important thing is that most of these profits are plowed back into the business of the banks through retained earnings. We see the same story with microfinance institutions: strong capital base, good liquidity numbers, improved non-performing loans, improved quality of their loans, and continued improvement in their profitability, which is more or less the same message as we saw from the banking sector side. The insurance sector, here we focus on the private insurance, which had issues for quite some time. But as you see in this first graph, for the first time in more than 8 years, we are having underwriting profit from the insurance sector. So there are reforms that have been going on since 2018, reforms in their operations, reforms in their pricing and understanding of the risks they are undertaking, reforms in managing risks, and all this has contributed to improvement in the performance of the insurance sector. And so this really shows us that now they are stable and can continue to grow and have the capacity to bring on board other products. So this is the measure of the stability of the insurance sector. Solvency ratio, which is a measure of their capital base, remains very strong. Their liquidity, which had been below our benchmark of 100%, has now moved to above 100% and remains strong. Profitability has also continued to improve, and we are happy with what we see in the insurance sector now based on what we had in the past years. Pension, I won't say much here. I just say that we continue to see improved assets of the public pension with increased contributions and increased investment income that continues to grow the assets of the of RSSB, the pension fund. So on the payment services, I think again what we see is more deepening of digital financial services. As you see, as a percentage of GDP, which is maybe the easiest measure we use to see how deep the digital financial services are. So we improved from 147%, the value of digital financial services as a percentage of GDP increasing from 147 to 200% last year, by end of last year. If you remember, I think just 3 years ago before COVID, we were below 50% for this measure. So we saw a big change from COVID. And the other point here I can stress is on the person-to-business transactions. In 2021, when the service providers reintroduced the service charge, we had seen the use of mobile POSs really stalled. But from mobilizations we had from 2022, we saw this increasing again. So we see more transactions on using the mobile or the merchant codes, which is something that is good and is really digitizing our financial transactions. So this is what I was saying. When you look at the active merchants, 2020 we had around 50, almost around 60. Then when the charges were introduced, reduced to about 50,000. Now this has really exponentially increased to more than 350,000 active merchants using the mobile POSs. And again, it's indicated in the value of the payments and the transactions. This has also greatly increased. So as an outlook, we see and expect the financial sector to remain stable and resilient despite the global challenges we see around us. We've really seen this state of affairs constant since COVID. We are worried of how that would affect our financial sector, but has remained strong and sound, and we expect to see this continuing. And of course, we will remain vigilant as regulators to continue overseeing what is happening in the financial sector. There are different risks, the climate risk and other risks, and so we continue working with the financial sector to ensure that the sector is really remains strong and adequate to withstand any shocks and continue serving their clients and serving the economy in general. So briefly, that's a summary of the outcome of the meetings of the two policy committees.